Thank you for staying with Benchmark. In the Voice of Business today, we focus on Sri Lanka's economy. Benchmark's Anushan Selvaraja explores issues such as the increase of the repo and the reverse repo rates by 50 basis points, the balance of payments crisis and the IMF mission's recent review of the SBA facility.
Welcome to the Voice of Business. Joining me on the show this week is economist and LMD columnist Samantha Amarasinghe. Now Samantha, the central bank surprised the market by increasing the repo and reverse repo rates by 50 basis points to 7.50 and 9% respectively in what was the first increase since 2007. Now could you elaborate on why this was done so suddenly and what are the implications of this move?
Well, to begin with, I don't believe it was a sudden move. In fact, it's a move that should have been implemented much earlier to avert this crisis. But what this policy move signals is a clear shift in policy stance by the central bank, and it highlights the central bank's concern that significant risks have emerged which could be a potential drag on growth this year. Credit growth, much of which has been import related, has increased beyond the central bank's comfort level, and it has in fact compelled the authorities to take a serious corrective action to bring it down to a more sustainable level and to avert a looming balance of payments crisis. The 50 basis points rate hike is aimed at curbing this alarmingly high credit growth and containing the country's burgeoning trade deficit. Credit growth, as you know, was at over 30% levels for much of 2011, and the central bank has set its credit growth target for 2012 at 16%. We feel that the marginal rate hike of 50 basis points and only modest LKR depreciation to date in the range of 5 to 6% might not be enough actually to effect such a sharp slowdown in credit demand.
Now will policy rates continue to rise this year, do you think? What are the sensitivities here?
In our view, yes. Our baseline scenario factors in 2 further rate hikes and so cumulatively a further 75 basis points of rate hikes in 2012. But we will, of course, review this call depending on how quickly credit demand responds to changes in both the interest and exchange rates, and also the central bank's directive to commercial banks to moderate their credit disbursements. As data shows that the sensitivity of import growth to the exchange rate has been relatively modest over the past 5 years, given that we expect the USD LKR to stabilize at 119 in the second quarter of 2012, we can assume that a substantial drop in import growth as a consequence of the rupee depreciation is unlikely. So to avert a balance of payments crisis, we believe a two-pronged strategy of currency depreciation as well as raising policy rates is required.
What was the outcome of the IMF mission's recent review to discuss the release of the next tranche of the $2.6 billion US dollar standby arrangement? Now, will the government draw on this facility despite the implications of a change in interest rates? Should we utilize the remaining funds?
Actually, the discussion at the IMF mission's recent visit was centered on resolving balance of payments issues more so than on whether the next tranche would be released or not. That said, the IMF seems very supportive of Sri Lanka's policy shift to a flexible exchange rate to contain the trade deficit. Therefore, in our view, it seems likely that the balance 2 tranches totaling 800 million US dollars will be disbursed. In some respects, we believe the central bank's latest shift in policy may have been a precondition, in fact, for the disbursement of the remaining funds. The government is likely to draw on this facility and has in fact intimated that a new letter of intent with the IMF will be signed this month. And yes, it would be in the best interest of the government to utilize the remaining funds due to the cheaper cost of financing such loans. If I'm not mistaken, the interest charge for the present amount outstanding of 1.7 billion US dollars is just 1.1% per annum, which is far more attractive than the interest rate on commercial borrowings.
That was LMD columnist Samantha Amarasinghe talking to Benchmark's Anushan Selvaraja. We hope you enjoyed the show. We'll see you again next week.